You finish a hard month of work and head to the bank. There is a deep psychological satisfaction in handing over a stack of leftover cash to a smiling bank teller. We are wired to find comfort in this routine. It feels as though the money is now sitting in a vault somewhere, guarded by a dragon and fully insured by the government. In reality, that money is already gone. Most banks function as a matchmaker through fractional reserve banking. They keep only a small fraction of your deposit on hand and lend the rest out to people buying a house or a jet ski. While the bank protects your account from physical theft, treating it like a permanent storage box exposes your wealth to a much larger invisible drain. You see the effects of this drain every time you go to the store. A bag of chips that cost $3 last year now sits at $4. This is inflation, a slow erosion of what your money can actually buy.
As the gauge on this diagram shows, the $5 bill looks the same, but it's losing its ability to pay for gas or groceries. When too much cash chases a limited supply of goods, businesses adjust their prices upward. Suddenly, that $500 TV costs $800. A predictable 2% annual inflation rate is common, but it actively punishes anyone whose wages stay flat while the cost of living climbs. Holding on to stagnant cash guarantees a mathematical loss. Over time, the safest place for your money becomes the place where you are most certain to become poorer. Fighting this erosion requires a pivot. You have to move from trading your time for money to trading your money for more money. This is the mechanic of investing. You are purchasing tiny ownership slices of companies, known as stocks, or loaning capital to governments and corporations through bonds. The force that allows these investments to outpace inflation is compound interest.
Simple interest pays a flat fee for your patience. Compound interest is more aggressive. Every dollar invested duplicates itself, and those new clones immediately begin earning their own rent. This compounding effect builds momentum over decades. Small, consistent investments grow into massive stacks of capital because the money is constantly multiplying itself. Fear of a market crash or a recession keeps many people from ever starting. During a recession, the economic party stops. Companies cut costs, jobs vanish, and the value of the stock market plunges as people prioritize necessities over growth. These crashes are painful resets in a larger cycle. Historically, growth eventually resumes, businesses rebuild, and the market reaches new highs. Time is the ultimate neutralizing force against this volatility. Wealth is built in decades, not days. Maintaining an investment over a long horizon allows you to ignore the temporary dips and let the compounding engine win. Currency is a social construct built on shared trust. A dollar bill has no more inherent value than a stick. It only buys things because society agrees that it should. To grow your wealth, you have to position your capital inside entities that create tangible, immense value for other people. Steve Jobs provided a massive amount of value by creating tools that changed how people communicate and work. Because millions of people found the iPhone incredibly useful, they traded thousands of dollars to get it. That exchange moved wealth from the public to the company and its investors. Positioning your capital in the market allows you to capture a slice of the value that innovators and companies continuously generate for the world. This requires a total shift in how we define financial risk. Temporary market volatility creates noise and fear, but it does not erode your long-term wealth. Inflation remains the constant, quiet engine that dissolves the purchasing power of every dollar you leave standing still. Your money is either an unpaid employee locked in a closet, losing its strength, or a tireless worker building your wealth in the market. The choice of who it works for is yours.